Your market news now. Stocks are trading within narrow ranges as traders await a pivotal U.S. jobs report for more evidence of whether the labor market is cooling fast enough to bring the Federal Reserve closer to reducing interest rates. Meanwhile, locally, Kumba Iron Ore, which is a unit of global mining giant Anglo American, says it's cutting production over the next 3 years to align output to constrained capacity to transport minerals via rail to port. It has also lowered its production outlook for the next 3 years to 35 and 37 million tons per year. Anglo American CEO says that the group has decided to slow the production at Kumba and move stockpiles until Transnet's logistics problems are resolved. To give us more perspective on the markets, we are joined by Jones Gondo, who's a senior research analyst at Nedbank CIB. Jones, thank you so much for your time. Your sense of market sentiment as we await that non-farm payrolls report, how important is it?
Look, I think the importance of this non-farm payrolls is just whether we get confidence that the Fed can start its cutting cycle earlier by March next year. But if it does show that actually there's still pressure on wages to the upside and that we could have higher rates for longer, that would really allow the market to go into a more bearish tone into year end. And that would mean that cutting cycles deferred and more pain in credit markets, I would imagine.
With that said, then, if you had to look at some of the rhetoric that we've had, or even some of what the numbers are showing on screen or the charts or whatever you're looking at, what are some of the contradictions that you're picking up right now that are in the market?
Well, I think it's this interplay of hard or soft landings for economies and monetary policy. I mean, just looking to the east, where Japan, the talk was really about whether they would actually have a rate hike in December, although their GDP also showed some weakness, and so the opposite starts to play, that they would actually need to be more accommodative, and so that's creating some contradiction in policy. And the same would be that it cuts both ways, even for the US. If earlier we had jolts, so job openings still seem quite robust, but non-farm payrolls, which is the pricing side of or wages side of the job market, might show significant weakness. And so it's a question of whether or not we're engineering a hard or soft landing is still not really showing itself in congruent numbers that give us confidence about the direction of monetary policy rates.
Looking back at the week, is there a company news item or even a theme that caught your attention?
Yeah, there are two big themes as a macroeconomist. The ones that really spoke to our market was NHI in the first instance, that the bill went up to the president for his signing. And I think the market took that as a marginally negative item because there's no, I guess, fiscal number that's tied to that bill. I think the idea that we would have to start funding this from day one probably got the market off on the wrong foot, but it's really a long way to go until we get there. And then the other big number was obviously our GDP number was quite weak. We had two previous quarters of fairly robust growth relative to expectations. And this time it was a lot weaker than expectations. So that has permeated itself through all asset classes. We've seen particularly the Rand go a lot weaker this week, touching 19 to the dollar as a consequence of SA-specific news.
The one thing that caught my attention this morning is ABSA releasing a trading update. That share price is down 6%, but they're saying here that credit losses are expected to remain high as a result of the increase in interest rates. If we're to talk about consumers here, whether we're looking at local or US consumers, what's important for you? Is it how much consumers are spending or how consumers are spending?
It's a bit of both. I think we know that consumers have been constrained for a long time, and that they've been trying to trade down in their consumer baskets. But we've seen things like core inflation remain sticky, food inflation remains the upside risk, And so that has really compressed their disposable income. And so with a delayed or lag effect, it's no surprise that that's feeding itself into bank credit losses and a real slowdown in the pace of, consumer sentiment. And that creates a second round effect for demand. Demand is really depressed in the US and in South Africa. But, this is one of the contradictions we had spoke about earlier, is that still prices and expectations for wages and things like that could still remain fairly elevated, which could give the consumer some space.
Your assessment of some of the moves we've seen in crude prices?
Yeah, the crude oil prices has been on a terrible 7-week trend down, even with the oil cuts that were proposed by OPEC. Basically, the market doesn't think it's credible that they'll implement those cuts. For a lot of the oil producers, it's a particular fiscal risk to have to cut production at these prices. And so even just today, we've seen a 1% increase in, oil prices are up at $70 a barrel, 1% up. But really, the sentiment is that the US's shale producers will continue to pump into their cuts, and the supply there will continue to be oversupply at a time when the world is still weak on growth and demand to take up any slack in the market.
All right, Jones, let's leave it there. Thank you so much for your time. That is Jones Gondo, who is a senior research analyst at Nedbank CIB. And perhaps when we do have him on the show the next time, we can talk to him about his expectations for corporate profits going into 2024. However, as we look at the markets right now, gold prices flat. And as we look at the numbers right now, we're down about 1.5%, the first weekly drop that we've seen in about a month. And this is as we look ahead to that important non-farm payrolls report. On the side of the currency, we are looking at the rand trading at 1817. Well, it was 1879 when we started off the trade, but we're around 1885. A little bit weaker as markets look to some of the local headwinds that are constraining any kind of short-term strength that we could see in the currency. We're going to take a quick break. When we come back, we'll have SME on point.